On December 10th, the year-over-year consumer price index printed an alarming 6.8%, which was the highest reading in 40 years, and it seemed to put to rest any hopes that the current bout of inflation was going to be transitory. Oddly, 10-year yields did not seem to acknowledge the inflationary risk, at least at first, when they went from 1.48% down to 1.41% in the days following the release. Now, for some perspective on that, the last time inflation readings were this high, the early 1980s, yields on the 10-year were above 10%. However, in the last few weeks, yields have moved in a more understandable path to a current level around 1.67-ish. Now, there are conflicting opinions regarding why yields haven't risen further. Many suggest that global bond buying has put an artificial cap on rates. Others believe that there's a very real worry right now that the rising pandemic numbers may destroy the recovery. Now, an interesting side note to this is that we've seen disproportionate put buying in the CME 10-year contract, the big contract, which trades inversely to the yield contract, as put buyers are willing to pay a higher premium to protect against further downside risk, which is an upside move in yields. Now, on January 12th, we're going to see the next reading of CPI, which will be an important indicator of the state of inflation and potentially the path of long-end interest rates. Now, if a trader believes that rates will move higher based on the increased inflation expectation, an example of how to express that opinion would be to buy the January CME micro yield contract, the one priced in simple yield terms, at the current level of 1.67 and target December of 2019 highs of 1.93. That's 2019, right before the pandemic. Now, a stop could be placed for this trade at 1.55, and if this trade hits its target, it makes $260, and if you're stopped out at your level, you lose $120. Now, if a trader believes that the bigger risk is rates moving lower, perhaps based on a declining pandemic picture, an example to express that opinion would be to sell the January micro 10-year at 1.67 and target the DEES of 21 lows near 1.40 with a stop placed at 1.75. This trade would profit $270 while risking $80 if you're stopped out at your level.